I think that there's a bit of air to come out of those stocks, really, but I think fundamentally there are a lot of fantastic businesses within that space that are very well supported, and it's really a question of identifying those stocks and picking the right stocks within that broader space.
In your research, you've pointed to the high-quality businesses that should do well around some of the COVID trends. Arguably, Apple was always seen as one of those high-quality companies, but even during this crisis, what we've seen, that company pushing its lower-end devices. So I sort of wonder whether there is an ability to have any sort of ability to price your product and services in this market. How would you sort of direct the audience towards some of the quality names still in this crisis?
Well, we think that clearly COVID has caused almost unprecedented disruption and has created huge challenges for companies. But in general, we believe that the high-quality businesses around the world are going to be best placed to navigate those challenges thanks to their established competitive advantages, which either give them pricing power or a cost advantage. And we think that's just only going to accelerate through this crisis.
Lewis, good morning to you, sir. Let's talk about green, because I notice your notes are all over the European Green Deal and green recovery. When I was in Como and Bracetti last weekend, that was a very hot topic of conversation. But the world ain't binary, is it? And we know that companies aren't just green or not green. They're not fairly ESG or very ESG. So my question for you is specifically around sectors which are doing their utmost to transform, and specifically out of favour sectors such as energy, which is the worst performing subsector in the US by a country mile over the last 12 months and beyond. How do you look at energy companies which ostensibly are not particularly green at the moment, but are making great strides to try and greenify and become more ESG friendly?
That's a very good question, very interesting question. I mean, from our perspective, when we think about what qualifies as a sustainable company and therefore merits a place in our sustainability portfolios, we're thinking about companies that can take advantage of the shifts in demand from consumers, government policies, and corporate strategies towards moving the world and helping that transition towards a more sustainable world. So we're looking for companies that are offering products or services that can help that transition. In addition, we expect the companies that we invest in to do what they can to minimize the negative externalities that their businesses create. And it's important that both those conditions are met. So it's simply not enough for a company to offset the negative impact of its business through, let's say, a charitable donation or environmental donations of such things. So from our perspective, it's got to make a material impact on the business, and otherwise you run the risk of your endeavors being construed as sort of token gestures, and that's where risks of greenwashing occur. So an oil company, in our mind, would not qualify as a sustainable business just because it donates some money to the communities in which it operates, just as an electric vehicle company wouldn't qualify if it used child labor in its supply chain, for example.